HDFC Bank posted yet another quarter of strong and consistent performance. The net profit increased by 18% year-on-year during Q3 FY22, aided by lower provisions and credit cost. Healthy loan growth and improved asset quality were the key positives that were partially offset by weak margins and fee income. Though margins were stable at 4.1%, it stood at the lower end of the bank's historical range of 4 to 4.5%. Higher corporate lending over the past many quarters, along with a pullback from high-yielding retail loans, had an adverse impact on margins. Management indicated that margins can rise gradually with improving loan mix. Also, the rise in interest rates would aid in margin improvement as yields on banks' assets will rise, but liabilities will reprice with a lag effect. PPOP growth of 10% during Q3 was subdued. Management indicated that in the future, PPOP growth should largely track the loan growth. This implies that pre-provision profit growth could be in the range of 15 to 18% in the coming quarters. Healthy build-up of contingent provisions will limit the future credit cost. The upshot here is that earnings growth will sustain around 18% in the coming quarters. HDFC Bank reported total advances worth 12.6 lakh crore as of December end, a healthy increase of 16% over last year, led by commercial and rural banking loans. Wholesale loan growth stood at 8% YOY. Retail advances grew by 13% year-on-year on the back of strong demand in mortgages, gold loans, and even personal loans. There was good traction seen in vehicle financing book as well. Growth in deposits was strong at 14% year-on-year. CASA ratio increased to 47% of deposits, which is an improvement of 410 basis points on a year-on-year basis. Despite robust growth in CASA deposits, NIMs remained steady at 4.1%. Now, management expects margins to improve with acceleration of retail growth. Fee income in Q3 was pulled down by weak performance in the credit cards business. Slippage ratio declined in Q3, which, along with better recoveries, led to a decline in GNPA. Restructured assets stood at 17,500 crores, which is equal to 1.39% of the loan book as of December end. Management sees a maximum 10 to 20 basis points impact on restructured book on NPAs. The bank created contingent provisions of 900 crores in Q3, taking the total contingent provision to 8,636 crores. Despite the contingent provision, credit cost in Q3 reduced to below 100 basis points after many quarters. Meanwhile, HDB Financial Services, which is a subsidiary of the bank, posted better performance in Q3. While the loan book did remain flat on a year-on-year basis, the lender reported a profit of 304 crores in Q3 compared to a loss of 146 crores in the same quarter last year, led by decline in provisions. Asset quality was stable with the gross stage 3 ratio at 6%. HDFC Securities, meanwhile, reported a very strong set of numbers, with profit rising by 58% in Q3 on buoyant capital market activities. The stock of HDFC Bank underperformed the broader benchmark as well as the sectoral index in 2021. Nifty gained 24%, Nifty Bank rallied by 13% in 2021, but HDFC Bank stock was a laggard, rising by a mere 3%. The underperformance is stark, especially when compared to peers like ICICI Bank, which delivered returns worth 38% in the same period. But that was the past. Now, 2022 could be a comeback year for HDFC Bank. Business growth is gaining momentum and margins are set to improve. The excess provision of 10,000 crores as of December end well equips the bank to accelerate future growth. At the current market price, HDFC Bank is trading at 2.9 times core book value estimated for FY23, which is at a discount to its historical long-term average multiple. We see promising growth outlook to outweigh near-term concerns on margins as well as fee income. Given the ROA of more than 2% and ROE of around 16 to 19%, valuation can revert to historical mean levels, which, along with earnings growth, can lead to meaningful upside in the stock price over the next year. While it has underperformed in 2021, HDFC Bank stock may prove to be quite the dark horse in 2022.